Thanks for joining us today on Market Call. I'm Morella Fernandez. Jerome Hass on the show with us today, portfolio manager at Lightwater Partners. He'll take your questions on Canadian mid-cap stocks. Here is how to reach us today, 1-855-326-6266. You can also send an email question to marketcall@bnnbloomberg.ca. Thanks for coming in today.
Thanks for having me.
Okay, terrible week on the markets. They're just getting hammered. I'm just wondering what you think has been hammering them. Is this tech or something else?
I think it's partly concerns about tech, but the broader question is, why are the markets up 20% in the first place? When you look at how the year started, we were talking about tariff wars in February. We had actual wars taking place. We have widening deficits. We have the shutdown in the U.S., slowing growth overall. And so somehow the stock market is up 20% in the U.S. and Canada. And that's more the bewildering question, not why we had the sell-off yesterday, although it seems to be pulling back today.
A little bit today. Yeah. Do you see the sell-off as a positive thing?
I think it's a healthy thing. I think we're at very high valuations in both markets, and I don't think it's necessarily justified by the fundamentals. I think there's a lot of froth that's come in about artificial intelligence, which has pushed up a lot of the tech stocks, and that's sort of pulled the market up. But it's kind of hard to justify on a fundamental basis.
Okay, and are you advising investors at this point to be cautious? I mean, with the pullback, maybe that you don't need to send that advice anymore, but how are you advising investors right now?
Well, we only pulled back 2%, and I think we're at, by almost any measure, record valuations in the markets. And so markets can continue to go up, but I would argue that it's limited, the upside in that. So some caution is warranted at this point.
Okay. As you mentioned, if it's only 2% pullback, are there opportunities that have changed this week that you would take advantage of?
Yeah, there's always opportunities, especially in the Canadian mid-cap space, where they tend to get a lot less eyeballs looking at it. The stocks generally are underfollowed and undervalued. And so as a consequence, there's always effective places to put capital to work in the mid-cap space.
And out of the mid-cap stocks, are you sticking with technology themes, or are you looking at mid-caps outside of technology? Where are you landing these days?
Well, we think there's pretty limited selection in Canada when it comes to technology stocks. We are focused in Canada. There is one name that we'll mention later on that we're quite positive on and have that as a long-term holding. But I think quality tech stocks in Canada are few and far in between. And so we tend to look to other segments of the market that are out there.
Okay. We're going to take a quick break. We will be back with Jerome Hass of Lightwater Partners. He's taking your questions today on Canadian mid-cap stocks. Here is the number to reach us and the email as well. We're back in a moment. Stay tuned. Welcome back. Thanks for joining us on Market Call. Jerome Hass with us today, answering your questions. The first is in an email from Yasmin, who says, may I have your thoughts on Linamar, please? Thank you very much. Linamar, one of those companies we thought would be greatly affected, right, by the trade war with the U.S., auto part, that kind of thing. But they've actually done pretty well to date. How do you think they've done that?
I'm very surprised when I see how much it's rallied from the April lows. In fact, I think it was hitting 52-week highs this week. So it is rather shocking in that sense. But on the other, when you look at the valuation of the stock, it's currently trading about 3.5 times EV to EBITDA, which is phenomenally cheap. But it is an auto parts sector, and it also has the mobility business, which is cranes effectively. And I would be very concerned in general about owning a Canadian manufacturer. Firstly, when you have a U.S. president that's trying to put the Canadian auto business out of business, I think it's always concerning. And secondly, for the mobility and manufacturing side of it, we are going to be renegotiating the CUSMA or the NAFTA agreement next year. And so who knows what's going to happen from that. President Trump hasn't exactly been very friendly towards Canada, so I would just be very, very cautious about Linamar. With its valuation, is it a value trap? I'm not sure, but it's not a name. We're generally very leery of the auto sector, even before President Trump came into power.
Would you wait until there's clarity from that deal before making a decision on that?
I think I would, but to be honest, we stay clear of auto stocks regardless, and so it's probably not a name that we would look at even if there was clarity in that.
Okay. Let's go to the phone lines then. Elliot's on the line. He's in Hamilton, Ontario with a question. Hi, Elliot.
Good afternoon. ElectraVera, the battery company, opening up a plant in the States soon enough. It rocketed from 3.5 to 10.5, and now it's pulled back halfway to around 7. What's your thought on ELVA at this point? Thank you.
Okay, thank you for the question. ElectraVera, are you familiar with the stock?
Yes, in fact, well, I can't remember how many years ago, but we had it as a top pick as a short, and it turned out very successfully for us. We've always been critical of the management team. There's a father-son combination behind ElectraVera, and they've certainly done better than expected over the last few years, but we're not sure a leopard changes its spots, to be honest, and so we just say tread very carefully on ElectraVera.
What concerns do you have about the business model or just growth opportunities?
No, I think it's more the management team in the past. The son has taken over now, has had a history of overpromising and under-delivering. And there's an almost comic track record of some of the ventures they've been in over the years. And so they seem to be doing better, judging by the stock market price of late. But, you know, I would say tread very carefully on ElectraVera.
You don't have full confidence there. All right. Let's go to Chris then in Calgary. He's on the line today with a question. Hi, Chris.
Good morning. My question is with regard to Chemtrade Logistics Income Fund. Thank you.
Okay, thank you for the question. Chemtrade, what do you think?
Well, it's an interesting name. It's actually done very well. I think it reported today or yesterday and seemed to beat expectations in that. It's trading off a little bit today, but it has really outperformed this year in terms of its guidance. I think it's about 14% ahead of the management's guidance, which is great. But on the other hand, it has had some tailwinds from commodities, and that always makes us nervous because those can reverse themselves.
Can you explain a little bit about how that works? In what way?
Well, it's just that there's various commodities that are involved as inputs within that, and it does impact their profitability in that. And so it's one of the reasons why that we generally would be leery about a name like that. But a former sell-side analyst has recently taken over the IR role from that, and he's been trying to convince me for the last 6 months to take a closer look at Chemtrade. So it's on our radar screen. It's interesting. One of the analysts that does cover it at Scotia, Ben Isaacson, who was a big fan of this, downgraded it yesterday or today, saying that it's had a good run year to date, and so I would just be a little bit cautious on that. But that being said, we're gonna continue to take a closer look at the name.
So it's on your watch list.
It's on our watch list for sure.
Got it. Okay, let's go to Ash on the line in Grimshaw, Alberta, with a question. Hi, Ash.
Hello. I was just wondering if I could have the guest's opinion about Northland Power. I was just a little gutted with the news yesterday, but wondering what his outlook is for it.
Okay.
Thank you.
Thank you for the question. Yeah, Northland got gutted yesterday. They cut their dividend, and there's an issue with guidance, I think, as well. So what are your thoughts about, is it a good time to buy in on Northland? Is this the company you think will recover?
We have not been big fans of Northland for a long time.
Why is that?
Well, we generally believe that there was too much enthusiasm went in for some of the renewable energy companies. And so we actually had short positions on a lot of them. And I can't remember if it was 22, they all went up like a rocket, and 23, they all came down. And so I think we covered the position in Northland back in 23 and haven't looked at it very closely. But it's interesting. It tends to be younger investors that like to back these renewable energies because they like investing in green things. And as a consequence, they were overvalued. And, it's coming back to roost right now. So we're cautious on the whole sector as well.
So you wouldn't put new money in?
I would not be putting new money in, no.
Okay. That is Northland Power for Ash. Let's go back to the phone lines. JC's on the line. He's in North Bay, Ontario, with a question. Hi, JC.
Hi, Jerome. Good to see you back. I'd like to ask about Kraken Robotics. It's pulled back a lot. Do you think it's a good entry point here, or is the kind of defense angle a little overblown?
Very good question. We've talked a lot about defense, right? With Donald Trump and NATO spending, people are investing more than ever. Countries are investing more than ever in the military, Canada included. Kraken does underwater sort of defensive pieces. Is this a company that you think has room to grow? How big is underwater defense?
Well, firstly, we're owners of this and have been for a number of years now. We've had a great run on it, and we're continuing to be very positive on it. And so you're right, they do underwater robotics, drones. They're primarily manufacturing the batteries in that. And when you think about a country like Canada, we're not going to be able to afford an aircraft carrier. We can barely afford submarines. And drones are perhaps a low-cost way for us to start being more assertive in terms of our sovereignty in the north. So it's a lot cheaper to have a drone operating in the north than it is to have a submarine or to purchase those. And plus, they can stay underwater a lot longer because there's no one on board. I think there's a lot of potential in robotics in this sense, in drones. And we love Kraken. We love the management team. We've met them many times. It's had a great run. But Audril, which is the U.S. partner that they have that they're supplying the batteries to, is certainly in growth mode. They're working with Australia with a White Shark project, as they call it. And we think there's potential that the Canadian government and the Canadian military will invest in that. So I would stick with your investment, and I would be buying on pullbacks on Kraken.
Okay. Kraken, by the way, at 5:33 today. We're going to take a quick break. We'll be back with Jerome Hass of Lightwater Partners. He's taking your questions on Canadian mid-cap stocks. Here's the number to reach us. We're back in a moment. Stay tuned. Welcome back to Market Call. Let's go to Perry's email. He says, with the housing and condo reset post-pandemic, I'd love to hear the guest's thoughts on the rental housing market, CARUN particularly, so the Canadian Apartment REIT here, which is real estate investment trust essentially. Is this one that you follow? Is this one that you like?
It's not one that we follow closely, but it's one that we like. I've actually bought it for a family member over the years, and she's sat on it. It's the largest and most liquid of the apartment REITs out there. I think they've got about 65,000 apartments. It's a $6 billion company with about a 4% yield, so you're getting paid to wait on this. Now, I know there has been concerns about the rental market in Canada. I think last week or this week it was announced there's 13 consecutive months of rent decreasing in Canada, which obviously is going to weigh on apartment REITs as a group, but they are probably one of the most defensive of all the REIT groups out there. And so even though the headlines aren't great, I think this is a very good name to own. It's a quality name. And there's a lot worse places to be. Canada still has a shortage of apartment housing, and these are one of the biggest providers of it. They've also been pretty good at recycling some of their capital, so they've been selling some buildings and buying some, which is getting a little more efficient in terms of their portfolio. There is another name that we'll talk about later on in the show that we prefer in the apartment space, but we think CapREIT's a very good place to park your money. Okay,
good to know. Let's go to Jake then. Jake is on the line. He's in Toronto. Hi, Jake.
My question is about the company GoEasy, GSY. Why they tumbled so much so fast, and is it good to buy it now or not?
Okay, thank you for the question. GoEasy, of course, probably caught up in credit concerns from the U.S. They lease different things, but they also do credit, I guess, as part of their business. Yeah. What do you think about GoEasy?
Well, it's been a very tough 18 months to hold GoEasy, and we do hold GoEasy. It's actually one of our probably top 10 holdings within the portfolio. So firstly, I think it was last July 2024, the CEO, who's very popular amongst investors, Jason Mullen, resigned. And so the stock tumbled after that and gradually started to build its way back, and people started to get more confidence in it. And then I think we got close to $200 around later on in this summer. And then all of a sudden, in September 22nd, I think there was a short report came out from a U.S. hedge fund. And so the stock tumbled, I think, 10% in the day in the news and another 5%. So it crawls back a little bit from then. And then they come out with results on November 6th, I think it was. And the stock went down 17% that day. So it's been a very tough time as an investor. And the short attack, to be honest, is pretty easy. Whenever you have complicated financial accounting, it's always easy to spin a short report on it. But the reality is, I think a lot of it was due to the growth of the automobile business and auto financing that they have within GoEasy. And so I'm skeptical about the merits of the short report. That being said, I didn't buy any more shares when the short report came out.
But you're holding on to what you have.
I'm holding on to it, but it's one of these things where they're the largest subprime lender in Canada. And much as American hedge funds used to pick on home capital in the past when they were looking for a target in prime, now the new targets go easy. So you're going to face this headline risk is what I call. But when you look at where they're trading right now, they're about 7 times PE this year, 6 going forward, depending on your estimates from that. That's pretty cheap for a company that's going to consistently grow. And, Jason Mullen had a pretty good line a couple years ago. He said, if you're concerned about a recession, our clients are almost always in a recession all the time. So when a real recession comes, they don't really notice it. And so the impact of an economic slowdown on GoEasy is probably a lot less than people realize operationally, but it still weighs on sentiment, and it's sentiment that's driving the stock right now.
Yeah, interesting way of thinking about it when you have clients who are, as he said, I guess permanently pressed.
Yeah, but at these levels, like I'm happy to sit on it. You just have to manage. For me, I have to manage the weight that I have in the stock. But the way it is right now, I think you should be a buyer, and I'd be happy holding this for the long run.
Okay. We hope that is good for Jake. Let's go to Chad. Chad's on the line. He's in Saskatoon today. Hi, Chad.
Hi, good afternoon, Marella and Jerome. Jerome, I'm just going to ask about Durham Limited. Obviously, in the last year, it's taken a beating. Would you ever get into a stock like this at this point, or do you ever see an upside to this? Okay, thank you very much.
Okay,
I'll hang up and listen.
Thank you for the question. When you have an activist investor involved, do you tread more carefully around these stocks, or do you have any philosophy of how to work with this particular kind of situation?
Well, firstly, with regards to activists, we're generally in favor of them because we think management in Canada is generally very complacent, and shareholders are even worse. They're like sheep generally in Canada. So activists can come in, and we view that very positively. And one of our top picks, it's one of the reasons why we think there's a potential catalyst coming up. In terms of Durham, we've never been big fans of the company, and it kind of reminds us of was it Valiant when they would buy drugs and then jack up the prices of them because they had monopolistic powers. And it was kind of the same model that Durham had. They were almost the exclusive supplier to a lot of legal firms, and so they would buy new entities and jack up the price. And so lawyers got tired with that, and now it's kind of descended to the point where it's a soap opera as far as I'm concerned with Durham. There's always one twist or turn. It's just not worth our time to take a look at it for a business that we didn't like in the first place.
Okay. All right, Chad, I hope that helps you make any decisions you need to make. Let's go to Sylvain. He's in Montreal with a question. Hi, Sylvain.
Hi. I would like to know your outlook for Superior Plus. Thank you very much indeed.
Okay, thank you for the question. I'm not familiar. Superior Plus?
Yeah, if you ever go up to the cottage and you see these yellow trucks, they're big bulbs in the back of them that usually says Superior Propane on them. So that was the original business, and they've been doing that for I don't know how many years, eons, ever since I was a kid. And so it's now evolved into it, but it's still essentially moving propane and other fuels within Canada and the U.S.
Also potassium, is that right? I've got potassium products as part of what they do, but maybe that's a smaller part of it. Okay, so propane generally.
Yeah, and so it's essentially a logistics business. And so if you look back about a year ago, it was in the doghouse with investors. It was trading around $6, and they had an investor day, which we attended in April last year, and they embarked in this new program called Superior Delivers. And what it was meant to do is improve the logistics of their business. And it was very simple things like managing the flow of trucks to optimize their profitability. And it was very straightforward, and the market bought into it. And so as you can see in the chart there, I think they got up to about $7.50 at one point earlier this year. But they announced the results yesterday or today, and the stock's taking a big hit because their big operation in the States They were looking for, I think, 10% growth this year. Now they've changed their guidance that they're probably going to have negative growth in the U.S., negative 5%. And then in terms of delivering benefits from their program that they had in terms of Superior Plus, it hasn't worked as well as they thought. So it's really taken it down to almost the $6 level. So we've gone in a round trip. We still think it's an interesting business, and we're watching it, but we just want to see them deliver.
What hit them in the U.S.?
Well, it's mainly the slowdown. So they supply to wells, oil and gas wells, and there's been a slowdown in that. So I think that's part of the issue there.
Got it. Okay. We're going to take a quick break. We will have a look at Jerome's past picks when we come back. Stay tuned. Welcome back and thanks for joining us. Time to take a look at Jerome's past picks from February 21st of this year. At the time, he chose Main Street Equity, MEQ, on the TSX. It was recommended at 278. It's down to 181.71. So a 9% return drop, a 9% total return drop. They do real estate. Well, it's essentially a real estate business. Do you remember why you chose it at the time?
Yeah, so we love this business and its business model, and the guy that runs it, a guy named Bob Dillon. So they're an apartment corporation. They're not a REIT, but they're the largest apartment owner and manager in Western Canada, primarily in Alberta and Saskatchewan. And the advantage of that is that they're not subject to rent controls there. And so what Bob does is he goes and buys down and out properties, fixes them up and puts them back in the market. But what they're doing is they're catering to what they call the mid-market. So their average apartment REITs are affordable. They're $1,200 a month is the average that they're charging. And there's a huge demand for that in Western Canada and in Canada in general. And what these guys have had is a phenomenal growth story. Since their IPO about 25 years ago, they haven't raised a cent in equity, yet they've grown at a compounded annual growth rate of 18%, which is unheard of in Canada, that a CEO has not raised equity in that long period of time. They're in a niche, and what's interesting about it is the REITs aren't interested in getting in that space. The pension funds aren't getting in, the institutions in there. So they've really got the market to themselves. And as we talked about earlier, the stock hasn't done anything this year because rents have come down across Canada. And because they're not subject to rent controls, they're probably more sensitive than they are in the East and Ontario and Quebec. But, they've got a lot of firepower in terms of dry capital. They'll put that to use in this market. And we just think it's a great growth story.
So you're holding on to what you have, obviously.
Absolutely. It's one of our top 3 holdings, actually.
Okay. Let's get to your next past pick, DRI Healthcare Trust, DHT. -U on the TSX. So they do healthcare royalties, I think pharmaceutical royalties, is that right?
It's pharmaceutical royalties. So a lot of viewers may be more familiar with the royalty model as applied to mining. So for example, Franco-Nevada has been around. It was one of the pioneers in this. It's a similar thing in that they'll give money to pharmaceutical companies who've developed a drug. And then, so typically they'd be between 25 and 150 million they'd give up front. And then they take a top line of that business for the length of the drug. And so, pharmaceuticals generally have a 17-year patent life in Canada. So they're long tail assets that they're acquiring. And it's a new application of the royalty model. So there's only 4 listed ones in North America. They are one of them. But what we really like about this is DRI only trades at 1.4 times book. Their 3 listed peers trade at 3.7 times book. Franco-Nevada, last time I looked, was about 4.8 times book. So this is dramatically undervalued relative to them. Then when you look at them in more conventional methods like price to earnings ratio, it's at 6 times. EV to EBITDA, it's at 6 as well. So this is really quick.
Okay.
Sorry.
Let's get to your last pick then. Secure Waste Infrastructure, SES on the TSX, it was $14.31 when you recommended it, $17.39 now, so 22% upside, 24% a total return upside. Have you trimmed it all? Are you keeping what you have with Secure Waste Infrastructure?
We did trim a little bit. It got as high as $20 earlier this year, which we thought was a pretty good run. So we did take a little bit off the table, but we do like this name. Essentially 75% of their business is waste management. So they extract water from oil slurry. They have industrial landfills. They do metal recycling, and they also do specialty chemicals. And then the other 25% of the business is essentially energy infrastructure. So it's storage, gathering, transportation. It's a nice business. It's got very high recurrent earnings, stable cash flows. It trades at about 9 times EV to EBITDA. When you look at its waste management peers, on average, they're about 17 times EV to EBITDA. And so we just think it's very, very cheap relative to this sector.
Got it. All right, we're going to take a quick break. We'll line up more of your phone calls and your emails for Jerome Hass for when we come back. Stay tuned. Welcome back to Market Call. Let's go to Tucson. He's on the line in St. Albert, Quebec, with a question. Hi, Tucson. What's your question today? Hello, Tucson? Okay, we may have lost that caller. Let's move on.
No.
Tucson, are you there?
I'm here.
Okay, what's your question today?
My question is on Whitecap. We have a lot of noise and a lot of news about oil going up and down the next 2 months. They're saying that the oil prices might actually fall. What's his view on Whitecap?
Okay,
Thank you.
Thank you for the question. Oil and gas company here recently with the takeover of Varen, right? Partnership there. Do you understand Whitecap? Like, is this a company that you follow? Have you invested in it in the past?
We haven't invested in it, but I did meet the CEO in January, and he's a bit of a force of nature. He's a very colorful guy. I think he's on the Hockey Canada board as well. So we had a very fun meeting with him and have a lot of respect for them as a company. But what's interesting about the names like Whitecap, and I think why they should be of interest, is in Canada, if you look at the 10 most actively managed funds, they are very underweight in energy in general. And so when they do have any exposure, I think they've got on average about 6% versus an 18% weight in the TSX. And when they do, they only buy the big 3 or 4 names in this. And so the companies that are in the tier just below that, and I would include Whitecap within that, tend to trade at a discount to them. So if you think about the global super majors trading at 7 times, the biggest Canadians will be about 5 times. And then in the tier just below that, you get the Whitecaps of the world that unjustifiably trade at a discount to the larger Canadians and the global super majors. And so I think that will change as more generalists come back into the oil and gas patch. And so from that perspective, I think you get a quality name in Whitecap that's not being captured by the market. So I think it's undervalued.
And they do pay a dividend.
Yeah, I believe so. I can't.
Yeah. I think they paid like a 6.6 dividend. Does that sound right to you?
I thought that seems a little higher than I thought.
It does seem high. Okay. We'll double check that number. But would you put money in there if it's undervalued? You would.
Absolutely, yeah.
Okay.
Like we need to diversify our investments in Canada, and so putting some money into the non-Big Five oil and gas it will help our country.
Got it. Okay, let's move on to an email from Bob in Winnipeg. He says, "What are your thoughts on Pollard Banknote? Will it ever get back to the mid-30s again?" We'll pull up Pollard and have a look at that. What do you think?
Well, this is a name that I got to admit, I missed the boat in the run-up a long time ago, and it's certainly come back a long ways. Viewers may not remember, but there was another listed company that was similar to this called Canadian Banknote that I think went bankrupt, or I think I lost a lot of money on it, so forever tainted me in this.
And they're in the lottery supply business, essentially.
It's very similar, I think, what Pollard does. In fact, when you drive to Ottawa, there's, I forget, it's on Welland or Wellington, I think. You actually drive by the Canadian Banknote building, and every time I go by, I go, I lost money on those guys. So when it always tainted my view towards Pollard, and it's certainly come back of late. And I recently looked at the valuation on it, and it struck me as pretty cheap. So you might start to get some value investors taking a look at it. I have not dug into Pollard at this point, but I got to admit, when I saw the valuation, I thought, okay, maybe justify putting it on the watch list.
Okay. That is for Pollard Banknote. Let's go back to the phone lines. Michael is on the line. He's got a question. He's in Toronto. Hi, Michael.
Yeah, hi. Thanks for taking my call. I'd like to get your thoughts on Keyera Corp, given its focus on natural gas and LNG, and which seems to be all the rage these days with the data center build-outs. I'll hang up and listen. Thank you.
Okay, thank you for the question. Keyera Core right now at 43.04. It's up a little bit on the day, down 4% on the year. Do you like Keyera? Is something you watch?
Yeah, like Keyera's a midstream player, so they're essentially the ones that take the gas or oil from the E&P companies and bring it to the pipelines. And so it's an infrastructure play. The one component of their business that is volatile is the marketing business. And so there was a big miss in their results either this morning or last night. And so the stock was down, I thought, earlier in the day, but it seems to have come back here now. You know, you look at a long-term chart in Keyera, it's just a great story. Infrastructure, energy infrastructure in Canada is a nice place to play, and we need more of it. And so as we build more, the Keyeras of the world will benefit from that.
Okay. We're going to take a quick break. Back with more of your phone calls in just a moment. Stay tuned. Welcome back, and thanks for joining us on Market Call. We have Walter on the line in Lindsay, Ontario, with his question today. Hi, Walter.
Hi, how are you? Thank you for taking my call. I was wondering if Jerome could fill me in on AG Growth International. I see they postponed their third quarter results and put a management cease trading order request in. If you could provide any insight as to whether this is a stock to keep or run away from. Thank you.
Thank you for the question. AG Growth sitting at 21.31. A bit of a drop-off here since end of summer, we'll say, beginning of the fall, and a 34% percentage drop on the day. So they handle grain, sort of storage equipment associated with that.
Yeah.
Any other specific reason you see for this descent from the fall?
Well, they do have a Brazilian business right now, and there has been a delay in reporting from the Brazilian business, and it's significant enough that they cannot put out their Q3 numbers
without that.
And so I think that's one of the reasons why the market is not reacting very positively to the fact that they're further delaying the Q3 numbers. And, you know, it's always a warning flag when anybody delays their reporting. And we were actually fairly early investors in this name about 20 years ago. And back then they were just in the auger business. And an auger is essentially, it's like a reverse slide with a scoop in the middle of it. So you basically, the grain comes in the bottom of it, it reverses it and it pumps it up into the silo. And so the grain actually takes its course on the augers. And so it's kind of a replacement business for the farmers. They need to do it every X number of years. It's got a little bit broader and more complicated in the last 20 years, but it's very dependent on the ag cycle. And it's one of the reasons why we stopped investing in it, because the ag cycle for us is something that's very unpredictable in the long term. And so we just moved away from ag names in general. So I haven't followed this name that closely in the last 10 years. But it was interesting. I was at a gathering of a bunch of hedge fund managers in August, and this was one of the top names that someone had as an idea. So it's clearly the recent expectations have disappointed the market.
Okay. Let's move on to Ghulam now in Toronto with a question. Hi, Ghulam.
Hello. Good afternoon. My question is on Northwest Healthcare. I was thinking of I don't have any exposure to REIT, so I thought I'd put it in there for dividends and some capital growth. But somehow I read somewhere today that they've been downgraded a little bit. So I was also looking at Sienna Senior Living. Which one would your guest recommend I buy?
Okay, so let's take a look at Northwest Healthcare. First, it's a little bit down on the day. It's $5.40. What kind of properties do they operate? Healthcare settings, would those be clinics, that kind of thing?
Yeah, and so what they do is they own buildings where you'd have like a dentist office or a doctor's office, and then they would put in, a pharmacy there, and they get a cut from the pharmacy. It was the original business model. So I think we were investors in these guys when they IPO'd, which is about 15 years ago. But they kind of lost their way. They were originally focused on Canada, on that business model, and then they went overseas. And so there was I think a separately listed international one, and then they merged them together. And at that point, we just said no mas. Like when they went abroad, we just said that's not the original business model. And so we kind of exited the investment in it. And I haven't followed it that closely, but they still do have some foreign investments. And, in a mid-cap stock, what you have to do to be successful is do one thing and do it well. And you can't do it in Canada and you can't do it abroad. So I think until they exit entirely from their foreign operations, I wouldn't touch this.
The comparison was Sienna Healthcare, which I think does sort of senior care living, right?
Yeah,
and
we're leery about that sector too.
Really?
Yeah, like I know it sounds like a great growth story because of the aging
demographics
boomers,
are there, yes.
But you just have to be careful about the labor element to that, because remember in COVID how difficult it was to get people to work in these places, and I don't think that's gone away. It's a great growth story in terms of boomers are now downsizing and moving into these things. I just think you have to be fairly cautious, and so we've looked at this sector and not been very impressed overall by it.
Okay. Let's move on then to William, who's on the line in London, Ontario, with a question. Hi, William.
Good afternoon. Thank you for your past suggestions. Do you have an opinion if I should keep TFI or buy more?
Okay, thank you for the question. TFI, so transportation.
Yeah.
Which is hard and not been sort of recovering the way some of the others have recovered so far this year. Do you think transportation is going to continue to be pushed down?
Well, TFI is an interesting case because it's a transportation company, a trucking company that should trade at much lower multiples than it has historically. In fact, we used to use this to hedge the position. One of our largest positions many years ago was Cargojet, and to offset the risk of that, we used to short TFI against that. And TFI has a cult-like following. As investors swear by the management team and the company, and we were just looking at American trucking peers that were trading at a much, much lower value, and we were like, why is TFI trading at the valuation that it does? And it's hard to short a stock when it has a cult-like following. So not a good short. I'm not sure I would suggest anyone putting money in it, but it does have a reputation for having a good management team.
Okay.
I think it's somewhat overvalued or overblown, that reputation, but there's worse places to put your money.
Okay, just for viewers' sake, it was last year in October at 218.06, down to 120.85 today. So just perspective on that. Let's get to an email from Brian. He says, please provide your thoughts about Enghouse Systems Limited, ENGH. They are an engineering services provider.
They're essentially a software consolidator. And so I always think of this as a poor man's consolation.
Okay.
And so essentially they buy redundant technologies, put them together, and they tend to be businesses that are and services that are declining organic growth. And that's something we've always had an issue with. We like to see companies that have positive organic growth. And when you're managing that decline, we think it's a tough business to be in. It also, like Constellation, had a lot of single-person risk. And so we just think he had to be very cautious about it on that basis. And so it's not a name that we've really had a big investment. We have had small investments in the past, but not for the last 10 years.
Okay. That is all the time we have for your phone calls and your emails, but Jerome has new top picks, which he will share right after this break. Join us on Monday for Market Call. Eric Nuttall will be on the show, partner, senior portfolio manager at 9 Point Partners. He'll take your questions on Monday on energy stocks. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from Jerome Hass. We'll start with Cineplex, CGX on the TSX. Cineplex, of course, very well-known brand. Everybody's gone to see a movie at some point. Yep. But we talk about a struggling business model in a time of streaming. But you think there's a catalyst here that could pop the stock?
Yeah, when you look at a longer-term chart on Cineplex over the last 10 or 20 years, it's not a pretty sight, but it hasn't always been that way. At one point, this was a stock market darling. So from 2008 to 2015, this was probably the most overowned stock in Canada amongst institutions and amongst investment advisors. And then it plateaued for about 3 years at $50. And then all of a sudden, it started to descend to the COVID lows. And what happened? Well, the knock was always the streaming services, saying the streaming services are going to eat Cineplex's lunch. We're not going to debate that, but we disagree with that. But we think there's a real catalyst right now for the stock. And the reason is that the long-serving CEO, Ellis Jacob, announced earlier this year he's going to retire at the end of 2026. So he has a clause in his contract for, I think it's 36 months, if there's a change of control. And the other senior managers at Cineplex have similar clauses, not as lucrative as that. But this could mean up to $12 million for the CEO alone.
If they sell it.
If they sell it. And so the board and Ellis, to be honest, don't own a lot of stock. So this would be very, very significant to them. So if we take that date, so the end of next year, we come back 6 months. And the reason why I do that is because if there is a sale going through, because they have 73% market share in Canada, for sure the Competition Bureau is going to look at it. So if you got that 6 month window, that means there has to be a bid for the company before the end of June next year. And so when you look at the risk return with a 7.5 month window, we think it's fantastic. Like our valuation of the company remains at $34, which is what Cineworld bid for it in 2009. There's an activist investor that's involved in the fund out in Miami called Windward. They think it's worth $31. If it's near any of those valuations, this is a pretty good risk return over the next 7 months. Yeah. So I know it hasn't been a great long-term investment, but if ever there's a time to buy Cineplex, it's now.
Now's the time. Okay, good to know. Let's get to Rockpoint Gas Storage, RGSI, on the TSX. Does exactly that, storage for gas, and one of the only players, I believe, to do that.
Yeah, I think it's the only listed one in North America, and they're the largest player in North America. Their assets are in Alberta and in California, and they've got about a third of a market share in both of those. And it's probably a name that's not too familiar with investors because it only IPO'd on October 9th. And so there's a 25-day delay in which sell-side analysts can put out their reports. So it was really only on Monday that brokers started initiating coverage on the stock. But what we really like about this is it's a play on the growth in demand for natural gas. The problem in Canada, when you look at the names to play natural gas, is you're subject to AECO fluctuations and low prices. And we don't really, I'm sure most investors don't like that. And this is kind of a way around that through the gas storage, because they're the guys who will be buyers of natural gas when it goes negative or very low pricing. So, for example, earlier this year when gas was negative 85 cents in AECO, they were vacuuming up all they could get. And then they'll go and resell that in February for $1.15. So we just think it's a very stable business. It has very low capex because they're using caverns to store the gas. There's very high barriers to entry. It's very difficult for new entrants to come in the market. And as natural gas or LNG emerges in North America and in Canada, these guys are going to be a beneficiary of that. So it's just a very conservative way to play natural gas growth.
Okay, let's move to your third pick, Descartes Systems, DSG on the TSX. Logistics software, essentially, what do you like about Descartes?
They're the Bloomberg of trade, is how people think about them. They're essential. If you're in the logistics business and you do cross-border trade, you need to use their software and their services. And so it's that high recurring element of the business that we like. their former CEO, a guy named Art Mesher, used to have a saying, at the start of every quarter, I know where 90% of my revenues for the quarter are going to come, and I spend the next 90 days getting the next 10%. So when you get 90% recurring revenues like that, it's a very attractive business to be involved in. And the stock has taken a hit this year, partly because of the tariff war that's going on, which ironically increases demand for their business. But the other is that all the software stocks in Canada have taken a hit, and these guys are down about 27%.
Just on AI concerns?
I think that's one of the reasons, yes. And so, it's trading near 2-year lows. Valuations are about as low as they've been and well below their 5-year averages. It's always an expensive stock. It's trading at about 22 times EV to EBITDA right now, but this is a great long-term growth story that's growing at 7 to 9% organic growth rates in the long term. And we just think it's a very attractive way to get exposure to the tech sector.
And now would be a good time to pick it up.
We think so, yeah.
Yeah, got it. All right, Jerome, I got to leave it there. I'm out of time, but thank you for your time. Thanks for coming in.
Thanks for having me.
And thank you for joining us today on Market Call. We'll see you back here again on Monday.